Hey there, everybody. Happy Wednesday, March 26th, and welcome to our latest episode of Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of questionable Redmond, Washington. We're bracing for what we're told is baseball-size hail here on the east side of Seattle. Should be interesting. Hopefully, the broadcast we're set to receive it around dinner time tonight. So fingers crossed. I've got my son going to soccer a little early. We'll hope that everyone's back inside and safe, and that we weather these storms okay. Speaking of weathering storms, kind of a down day for the markets, a down day we've not seen in a couple weeks here, and so again, this counter trend rally has been pretty quick, pretty severe, pretty significant. But sure enough, the S&P failing to gain or hold the gains above the 200-day moving average. Arguably, the S&P 500 featuring a lesser common but still valuable evening star candle pattern, which is a 3-candle pattern. I'll share with you when we get to the chart review portion of the session. A lot of things going down, but you'll see actually about half the S&P sectors were up. This was a big down day for growth, particularly mega cap growth. You'll see that on the heat map. You'll see that when we look at the sector movements. You'll see that when we look at the charts. A lot of things were not down today, and a lot of things are actually doing okay today. But generally speaking, more stocks down than up on the NYSE. And the problem was the types of names that were down. It's the big mega cap growth names that have huge weights in our benchmarks. Hopefully, some of you were able to join me earlier today for our webinar on relative strength, which actually I hope what you found a really valuable discussion. Had some really thoughtful questions during the event, which was really cool. So I hope you enjoyed that one. Things we touch on in the course of the webcast or of the daily show here, but a webcast gives us a little more time to dig into those topics in a little more detail. So hope you can tune in for the next one if you weren't able to make today's free webinar. All right, let's take a look at how the markets played out today. Kind of down day Wednesday, I guess we'll call it. The S&P 500 down about 1.1%. That's to close around 5712. Now bounced just slightly in the last hour, but really the main part of the day was pretty rough. So that's taking the S&P back below its 200-day moving average. We pushed above it earlier through the course of this week. For now, pushing back below again with a bearish candle pattern. I'll show you in a little bit. The NASDAQ composite, though, leading the way lower, down over 2% to just below 17,900. That's for the NASDAQ composite. Mid caps and small caps all down, but the S&P 600 small cap index down the least, down about 0.5% compared to the S&P's 1.1%. So with the NASDAQ down 2%, the S&P down 1%, the Dow down 1/3%. You can see it was sort of growth underperforming value. And again, just the biggest names pushing the way lower. And that's going to hurt the overall averages today. The VIX moved higher over 1 full VIX point to 18.3. So we're still below 20. So still in a low volatility environment, according to that general sort of gauge of low versus high volatility, but certainly something to watch because the VIX has been steadily trending downward over the last week or two. See if we get a rotation higher. If so, that would be one of those big red flag kind of rotations we may be observing here. Looking at the fixed income markets, you can see bond prices went down today. So this is one of those days where stocks and bonds kind of moved lower. There's been a bit of an inverse relationship between those two asset classes recently, but today you have both of them moving to the downside. The TLT down about 0.2%. Interest rates, looking at the 5, 10, 30-year interest rates, all moving higher today. The 10-year yield currently around 4.34, we'll call it. Long bond yield around 4.7%. 5-year point pushing up to around 4.1% almost today. The dollar index, not much of a change today. Just up slightly from yesterday, about 0.5%. Looking at the commodity space, you can see sort of mixed, but not a big movement day in the commodity space. Gold and silver were slightly lower, but that wasn't much. That was a pretty light day. Crude oil prices slightly higher. Energy continuing to look pretty good on a relative basis for sure. We'll talk a little bit about the relative performance there. Did come up in our webcast earlier today. And again, a lot of value sectors and certainly defensive sectors doing pretty well, but energy top three sector today. All right, looking at the cryptocurrency space, kind of moving around along with the equities. Although Bitcoin actually rallied pretty good in the last 6 hours or so, bottomed out just below 86,000. Currently trading just above 87,000. So maybe a bit of a divergence here between stocks going lower and cryptocurrencies going higher. Maybe an emerging theme. Cryptocurrencies and stocks generally have been moving together. Sort of been a play on speculation, just sort of like a leveraged bet. As a risk asset, but today a bit of a divergence here with a nice pop here going into the end of the equity session for Bitcoin. All right, looking at the 11 S&P sectors, again for how much of a bad day this probably felt like, and if you're looking at the chart of the S&P and the Nasdaq, probably felt like an everything down kind of day. But if you really look at the data, it really wasn't, and there are plenty of things that actually did okay. It's just the types of things that didn't do well and the types of things that did do well tell you a bit about the general investor sentiment right about now. Your top performing sector is consumer staples. Do not adjust your speaker. That is what I said. Consumer staples, the top performing sector. I haven't said that one in a little while. Up 1.6%. A lot of the consumer staples stocks have not looked particularly good. Other areas of the markets have certainly looked have looked much stronger. So 1.6% puts it at the top of the list. And sorry, that ding, if you heard that, I don't know if my phone picked it up, was our soccer club canceling my son's practice. I was wondering if that was going to happen during the broadcast. So there you go. You're all updated on the club soccer weather situation here in eastern Western Washington. All right. Utilities number 2, up 0.2%. Energy up 0.6%. That energy chart, we talked about the chart of crude oil yesterday, and I got a lot of great comments as we were reviewing that. And I shared that with my premium members this morning with some additional thoughts and perspective on that. Energy really emerging as an interesting idea. Someone mentioned, which you're absolutely right, Julius de Kempener, friend of market misbehavior and interviewee on my podcast earlier this year, came out in the last week and talked about energy rotating in a position of strength. Would wholeheartedly agree. We're looking at a lot of that same evidence that shows a resurgence in that sector, which has been an underperformer for quite a long period of time. On the downside, technology, and this is where the weightings in the S&P sectors become so important. The bottom 3 sectors are the 3 FANG sectors, right? Technology down 2.25%. Consumer discretionary XLY down 1.33%, communication services down 0.9%. So these 3 sectors, represent quite a bit of market cap. Communication services has actually been outperforming pretty well in 2025, one of the better relative performers. But the XLY very much not, and the XLK also not. I did keep some of those charts of the FANG stocks in technology to review, really starting to, again, all about the 200-day moving average, still very much in play, and some of them failing to hold it even today. Looking at the breadth, what strikes me as I was reviewing this evidence earlier today, look at the breadth in the New York Stock Exchange, 61% down, 37% up, about the same for the NASDAQ composite. But look at how the S&P very different, 53% up, 47% down. So the S&P was kind of a coin flip as to whether an S&P member stock was up or down on the day. But if you look at the NASDAQ, you look at the New York Stock Exchange, broader universe with a lot more, different areas represented. Certainly in the NASDAQ composite, a lot more growth of tilt to the stocks, way more negative. So it was sort of like the closer you were to kind of the value space, the better you probably did on a day like today. But very interesting that the S&P was actually net positive advancers over decliners, where, again, it certainly didn't feel like that. Now, part of the reason why it did not feel so good today is because this happened to the Magnificent Seven stocks. These are your leading mega cap growth names. You could see Apple's the best performer. It's still down 1%. Microsoft, which is one of the top 3 names in the XLK, down 1.3%. But you have NVIDIA down almost 6% today. Tesla finally having another down day after a fantastic counter trend bounce, as I continue to label it, down about 5.6% today. Broadcom, which I recently added to this list of Magnificent Seven and Friends. You start the stopwatch. When I added it to this list, I feel like it's been in a free fall from that moment on. But so far, Broadcom down almost 5% today. So this basket of names certainly is vital. We learned that last year, where the Magnificent Seven stocks dominated returns, certainly for much of the year, and in certain parts of the year. I mean, they were the story. You had to be there to have any opportunity to outperform the S&P 500. I think still super important because there's such a big weight. And so, how these stocks go, so goes the market. I mean, that's pretty fair. Now, what's interesting is in a day like today, it's a reminder that even if these stocks struggle, even if the S&P and the NASDAQ get dragged down because these big names are hurting, if other areas of the market are up, that presents a fantastic opportunity to outperform. So the S&P and the NASDAQ could be down, dragged down by growth on a day like this, but other areas of the market were up on an absolute basis. That's an important message to remember. That's why looking at the market carpet, a heat map, is super helpful to find things that are up on a down day for the benchmarks. This is why thinking of sector relative performance and looking what is rotating in a position of strength. If assets are flowing out of these names, where are they going? Are they going to value sectors, defensive sectors, hard assets, precious metals like gold and silver, bonds, other things? And let's use the charts to identify and understand where the flows are rotating, because the price will reflect those things. At least that's the argument for what we do as technical analysts. All right, let's continue on looking at the market carpet. This sort of heat map visualization is super helpful and in just terms of understanding the big picture and the micro picture all in one visualization. So here are some rapid fire observations looking at the heat map. So first off, we have like the axis of evil in the middle, these big mega cap growth names that were down quite a bit. It's worth noting on the left side, Apple and Microsoft down the least. I mean, those are down only 1.25% or so. So compared to Nvidia down almost 6%, Amazon over 2%, Tesla obviously down, as we mentioned. The three big communication services stocks, Alphabet, Meta, Netflix, all down 2.5 to 3.25%. So these represent some of the larger names. And, worth remembering on this heat map, these boxes are scaled by market cap. And most visualizations, like FinViz is another one I've used many times. The size of the boxes are scaled based on market cap, but they're not exactly right. It's not like each pixel represents a certain amount so that it maps 1-to-1. And the reason is because the heat map would be illegible for most of the 400 of these tickers. You wouldn't be able to read, and the big boxes would be huge because there's such a big weight. So it's scaled so that the largest boxes are a little smaller than the numbers would reflect. The smallest ones are a little bigger, just so we can still see the color and see the ticker. So while this looks like pretty even, you have to remember that these boxes that are these big mega cap names have a much bigger weight in the benchmark than even the visualization would imply here. It actually implies a little less of a weight than is there. Having said that, that's one thing that stands out, is obviously a lot of these names have been looking pretty good here during this counter trend bounce. They've had nice bounces off the low, arguably now, I would argue, now kind of resuming the primary downtrend that was established from mid-February to now late March. I see this recent bounce as a counter trend move, and a day like today tells me, yep, we have more to go. We'll see. And with a lot of these names, again, the 200-day moving average very much in play, and something to pay attention to. Other things that stand out to me, I mean, look at the defensive sectors, right? You have consumer staples, which has not been a great sector recently. A lot of these names have been, sort of flat to down, while the other growthy stuff has been bouncing. Now you're getting back to some of these defensive areas of the market looking a little bit better. Consumer staples, real estate, utilities, sort of examples of that defensive group of sectors. Elsewhere, energy, materials, industrials, which are really more cyclical sectors, what I kind of call a value bucket. Those are sectors that actually are doing pretty well as well. Financials in that same kind of group of value sectors. I did grab the chart of the relative performance of those sectors just to show that, I would say in the last, year to date, if you think of a basket of sectors that have done the best, those value sectors have been the most impressive on a relative basis. I think that's important to remember. But yeah, I mean, from this, I would say the nice bounce in consumer staples is one that I'm watching. I did grab, I think, a chart or two from that sector. I'm trying to think which ones I grabbed, because I grabbed a lot of them earlier, but I would certainly be keeping an eye on some of these names that have been struggling, that have stalled out, pulled back a little bit here, mid-February to mid-March. If we do get another leg lower, I could see charts like Molson Coors breaking to a new swing high very quickly. If those end up being, the place where investors start rotating, we start getting defensive. These are the types of names that people tend to flock to. So keep an eye there. I think that's it for the heat map. Shall we keep going? Let's look at some charts and focus on what we learned today. So, I have these shaded areas on the chart. This shaded area, this rectangle, came from this gap, this price gap in early November. This was the election gap, right? We had election day on Tuesday. The next day, we gap way higher at the open and trade even higher from that. That was sort of a pivotal moment. Certainly, it appears in U.S. political history and certainly in market history, because that range from around 57.70 to 58.70, we'll call it, that sort of range, has proven super important. That's where we actually tested support a number of times here in November, December, January. Again, we traded down into that gap range and then traded higher. We then finally broke below it in early March. And when again, if we do end up going much lower from here, I'm probably going to end up writing a book, or at least some really cool something about this top, because it is literally like checking all the boxes of what happens going into a major peak, how the peak tends to play out, the leadership rotation, the structural changes, the breadth and momentum, evolution, the divergences. It's kind of doing a little everything. And if the cherry on top of this is we have a breakdown below the 200-day, and then we trade up and test it from below and then fail there, and that's pretty much how you would script a major top to look. This is the case study. I feel like this is what future tops would be compared to, because this is how they kind of look. And what's worth looking at is we're looking at like a 6-month period here, right? Tops. A lot of people think of tops as a moment, right? And you have to pinpoint it. It's really not. There's a lot of time, a lot of times, right, to just recognize that there is a change. Recognize there's what we call a change of character. So, having said all that, the fact that we're rallying up to that gap range, that we're trading up to the 200-day moving average, we get above there and have 2 closes above, and then today we rotate back lower, is not bullish. That is not a bullish way of interacting with these key levels that we've talked about. Suggests to me that the primary downtrend is alive and well, and that we probably have further to go before all is said and done. The fact that the RSI stalling out is at 50 kind of validates that whole general way of thinking. I will be the first to tell you that is completely wrong, and that we are going to most likely retest the previous all-time highs. But we'd have to do better at pushing above resistance than we're doing so far this particular week. Now, I just want to zoom in a little bit. Here's the candle chart of the S&P, just to highlight this 3-candle pattern. This is called an evening star pattern. This is a 3-candle pattern. We have like an up bar and then a sort of a small real body up here, and then a down bar. And you actually might call this, what do you call it? An evening doji star, I think you would call this. Might have to look that up and confirm it, but that sounds right to me. That feels right. The way I think about this particular pattern, by the way, is it's pretty much a bearish engulfing pattern. If you ignore this guy in the middle and just look at this as a 2-bar pattern, right? Here's day 1, skip this one. Here's day 2. So if you connect these two, it's like it's a bearish engulfing pattern, right? A higher open, a lower close. The evening star pattern just has this 3rd day in the middle. So it's sort of like the big up day, a little hop higher to this small indecision day, and then the big day lower. So it has the same kind of feel as a bearish engulfing pattern, which is obviously bearish. And the next 1 to 3 bars generally would be lower in this scenario. The fact that it's happening right at the 200-day moving average doesn't feel like a coincidence to me. I mean, a lot of times when you have a stock or a chart testing key support or key resistance, when a candle pattern happens at that major level where you'd expect some sort of change in sentiment, and when it actually plays out there, I think it just further validates the fact that the 200-day moving average is pretty important. There's a lot of people maybe paying attention to this, and for now, we're seeing more supply than demand. We're seeing more fear than greed. This 3-bar pattern suggests further downside from here, at least until proven otherwise. Looking at the breadth indicators, again, we've covered breadth kind of randomly with different charts today. I just want to keep the same chart. This is the percent of stocks above the 200-day moving average. If we do sort of begin a new leg lower, if this ends up being like a big wave C kind of move, which is certainly a possible scenario, this indicator is just going to be further elevated in my own thinking, because it's worked particularly well here. The break below 50% for me is kind of that confirmation that we're in a downtrend phase, in a bearish phase, and you look to see if it's able to regain that 50% point. And for now, it's not able to do so. We're kind of stalling out here. While the S&P is back below its 200-day moving average, it's basically saying it's a 50-50 split right now between S&P 500 members above or below their own 200-day moving average. What's also interesting is just look at how this indicator has evolved over the last 4 months, right? October high, we make a new all-time high around 58.50. That's around 82% of S&P members above their 200-day moving average. Here in November, we're making the new high above 6,000 for the first time, and we peak out around 76% of stocks around their 200-day moving average. Here in late January, we push above 6,100 for the first time. We're down to 65%. Here we're making another new high around 6,150. We're down to 62%. So and now we're rallying and we're way below 50%. So every one of these new highs came with less and less stocks, sort of regaining their 200-day. And so there was distribution happening kind of underneath the hood that we've not really, that really just, again, is classic behavior at a major top there. So for now, that indicator remaining below 50%, pretty important. Hopefully, speaking of the VIX, I hope most of you have been able to review my interview with Jay Soloff of Investors Alley. He's the lead options analyst. We talked all about volatility, the VIX, how it's structured, what it means, VIX futures, and some different thinking. I thought that was really, really helpful. I really enjoyed asking him some questions about all things VIX. So with that in mind, it's worth noting that the VIX has just been in a very consistent downtrend from early March to now late March. And this is as the S&P has had its counter trend rally here. We're seeing volatility decline. And so the VIX back below 20, which is pretty important. VIX pops above 20. And I think that, again, for me, that would be one of those red flag, okay, the next big move is starting. So if this is a big wave A and then B and then a big C wave is coming, the VIX, almost certainly pops above 20 here very soon. Certainly if we initiate a new impulse move to the downside. That's why I think this would be an important chart to watch. For now, we're bouncing higher today, but the VIX ending the day around 1840, 1830, 1840. I wanted to grab this chart of the relative performance of some of the key value sectors. So I think of the 11 S&P sectors in 3 buckets. You have the growthy stuff, technology, communication services, consumer discretionary. You have the defensive stuff, utilities, real estate, consumer staples, healthcare. And then you have this bucket, which are more value sectors or cyclical sectors, industrials, financials, materials, and energy. It's very interesting to me that if you take those 3 buckets, which bucket of sectors has done the best or is in the most constructive relative position, I would say these 4 sectors as a group are probably the most successful. So on the top, you have industrials, you have financials, and financials actually had a pretty good run, for the last 8 months on a relative basis. But, late February into early March, a lot of the banks pulled back, regional banks pulled back. But overall, look at this, is close to making a new, multi-year relative high, which shows you that, again, continuing to outperform. Also a nice uptrend in materials, nice uptrend in energy. And again, we talked yesterday about the chart of crude oil and that repetitive pattern we started to see in analog using some of the recent pullbacks over the last couple of years and how we might be seeing the beginning of a nice upside move in crude oil. So if you missed that, that was on yesterday's show, I want to say. So make sure you check that out. Good discussion from yesterday. So these are the areas of the market demonstrating relative strength. And one thing I've learned in any environment is when in doubt, focus on areas that are showing improving relative strength, where they're outperforming the benchmark. Regardless of what the major indexes are doing, whether they're breaking out, breaking down, whether they're sideways, being in stocks and sectors where the relative strength is improving is a tried and true way of outperforming the benchmarks and just reaping the benefits of active management. And so some of these sectors are where I'm finding some of the more compelling opportunities, and these are the general areas where I'm leaning into in my own approach. All right. I had some of these charts on the show yesterday. I just want to keep them updated. We'll probably have these here for a couple days just to track how they're doing relative to their 200-day. Meta pulling back today, and all three of these names, four of these names, I think, pulling back today. So for now, Meta, the RSI remaining below 50. We're stalling out right at that swing high from mid-March, now potentially rolling over a little bit. Again, for me, it's below 575, which would take us below the 200-day and below that swing low from last week. That's the level to watch there. For now, it's holding. Amazon actually traded right back down to its 200-day moving average. Looked for a little while this afternoon like it might actually close below it. It did not quite. So we gapped above it 2 days ago on Monday. Yesterday up, today back down. So again, the 200-day moving average very much still in play here for Amazon. Tesla, not great. We talked yesterday about this candle called the Hanging Man candle. Worked out pretty well today because we had a nice distribution day right back below the 200-day moving average. So Tesla actually failing to get a foothold above the 200-day. So all three of those, I think the 200-day and what the price does relative to that key measure is super important. Now, why do we do that? I mean, I think there's a lot of value in smoothing out price data with moving averages, but I will tell you, having worked with a lot of investors at a lot of different firms, even those that are not big chart people, always seem to know where the 200-day moving average was. Every buy-side trading desk I've ever been on, they really speak the language of technical analysis, and they're all pretty aware of the 200-day moving average. I would often get questions about that in particular. And so I know a lot of eyeballs are focusing on that level. And for me, that's why it's important to see whether we're able to regain it or not. Broadcom breaking below its 200-day moving average. And again, I added this to the list of Magnificent Seven and friends here a couple days ago. And from there, it's pretty much been in a free fall. So you can blame me for the downswing because I had made the bold decision of adding it to a list of leading growth names. From there, it started to come down a little bit. Now it's still holding its early March low, right around 176, 177, but closing below the 200-day moving average for the first time in over a year. I think that could be a really bad sign because what that means is it looks like we're putting in a lower high around 200 and now very close to making a lower low and finally breaking below the 200-day moving average. For me, that's the type of chart I avoid. If it can't hold the 200-day, particularly after being above it for so long, I'm super happy rotating to something else. Note, by the way, very close to making a new 3-month relative low, which was a scan we talked about running on the webcast earlier today. Casey's General Store. This is actually a name that came up in a scan that I ran earlier today on stocks demonstrating strong relative strength despite market weakness. That actually made a new multi-year relative high today. This is a stock that was up over 2% today while the broad markets were down. This is a consumer staples company, kind of in that sort of general store kind of feel. You can see the bounce higher. You know, from a technical perspective, I would say still I would love to see a break above resistance. So we have resistance here around 440. We retested that in mid-February. We pulled back to test the low around 380. That's the low from early November and mid-January. So now we've bounced off of support and the 200-day moving average, trading back up toward resistance. I like the fact that we're improving relative strength and improving price momentum. The more, the better. But for now, the fact that it's doing well when the broad indexes are not doing well is meaningful. Dollar Tree came up. I saw this chart because it was up 3% today when, again, major things were down. So sort of focusing in on staple stocks that were up today. But I would say, remember, from a technical perspective, still more to prove. I always quote Jesse Livermore, there's time to go long, time to go short, and time to go fishing. And this is one of those charts where I think Jesse Livermore would say, let's wait and see, right? We have clear resistance around 75 to 77. That was the high from mid-September, December, January, February, all right around that same point. So getting above that would be meaningful. And also that would mean getting back above the 200-day moving average, which we've been below for so long. So you're kind of playing an upside breakout. The downside risk is kind of defined to around 61 to 63. Those would be the swing lows from late last year, early this year. So overall, I think a breakout could be really constructive. It would really demonstrate a rotation from a distribution phase to a consolidation phase to a new accumulation phase. Still to be announced. Prudential, a chart to watch. Some of the insurance companies have done very well on a relative basis here in the last 6 to 8 weeks. Prudential having improving relative strength, improving momentum, which is good. Trendline resistance from the November peak, the January peak lines up almost perfectly with where we are right about now at the close. Now we're testing the 200-day moving average. We're testing the late February high. We're testing the trendline resistance. So we have a confluence of resistance, 3 different approaches, all triangulating right around this level, which for me says set the trigger for a breakout above those points. So I'm looking at break above 117 would unlock much further upside potential for Prudential. We're right there, but not quite there. That's a name on the short list to watch. Finally, Aptiv, I would say another thing to think about with areas of the market that have been struggling. This is an auto parts company. It's actually done quite well since mid-November, but the long-term trend you can see has been down for quite some time. It's been below the 200-day moving average for almost 2 years now. However, we are threatening to get back above the 200-day. A number of attempts to get above the 200-day have failed. We failed most recently in mid-February and early March. Now we're right back there. This is the kind of chart making a higher low. Breaking above the 200-day could be a really good signal indicating further upside to be seen, but we'll see. And so I think that's again another chart. There are charts like this that are kind of on the watch list, and we'll see what happens next. All right. Yes, I do see some comments, and yes, full disclaimer, friends saying Keller made me do it. No, I did not. Full disclosure, not a recommendation at any point. All right, let's see what else we can see here. Yeah, Larry, thanks for sharing. I knew this headline was going to be coming on. I was trying to just see if we would get any clarity before we went live on the live stream, and we did not. Unilateral 25% tariff across all stars not made in the USA. I haven't had a chance to go through that, and a couple others weighing in. I appreciate you guys sharing that. I haven't had a chance to look at that. I mean, this has been the risk, right? The headline risk. When I was taught when you're analyzing equities, I was taught this years ago. It was like you think about all the risks, right? When you're buying an equity of any sort, you are taking on risk, right? If you want no risk, then buy a U.S. Treasury bond. There is a minimal risk that the U.S. will not meet its debt obligations, but with the ability to print an unlimited amount of money, almost impossible to imagine that would happen. So, the U.S. Treasury bond is pretty much a risk-free investment for all intents and purposes. So, if you do anything beyond that, like a corporate bond, right? So, a loan that a company is making, maybe a higher risk that they're unable to pay their debt. So you get a little higher yield, right? Trades at a spread, at a premium to a treasury bond. In equity, you're taking on ownership in the company, which means you're taking on risk for the opportunity for greater return. So what are those risks? Well, there's market risk, there's volatility risk, there's earnings risk. Like there's all these things that happen, but there's also, I would say in this environment, headline risk. The fact that a headline can come out and completely rupture everything. Now that's always a risk, but right now, it is a higher than normal risk because of the flurry of headlines we've gotten with the new presidential administration. Whether or not you agree with any of those policies, and this is not the forum for me to hopefully even indicate how I feel about it, but I would tell you the risks are very real. And so if you're buying stocks right about now, you are accepting the risk that car companies all of a sudden get dinged with 25% tariffs. It's really a tariff risk. And the impact and how this is going to impact companies' bottom lines 3, 6, 12 months down the road is unclear. But if we have to value companies today, we have to include that uncertainty into our valuation. I think that makes stocks less valuable today because of the potential that they're going to have these headwinds. They're going to hit them going forward. And so I think this is very much the reality of where we're at. Fun time to be looking at the markets, isn't it? All right. Dave, Mohammed, thank you so much for watching on YouTube. You asked, Dave, can you give your view on Walmart? Technically bullish or bearish? I will take a shot at that. All right. Let's see. Walmart. Yeah. So right. So let's look at Walmart, and again, think about it from a couple different time frames, right? I would say in the starting long term to short term, I would say on the long term, the long term trend is still okay, and I would say still okay by the fact that we're still above an upward sloping 200-day moving average. On a weekly chart, we're still making higher highs and higher lows. That's a pretty decent uptrend. In the medium term, which is kind of like looking out a month or so, I would say concerning because this pattern right here, after the gap lower in February, we've really continued lower. That was earnings where we gapped lower. And again, Walmart and Costco, I mean, two of the strongest charts you could come up with going into the first quarter. I mean, two just consistent outperformers in 2024. And both of those names looked more like growth stocks. They looked more like a technology name or a communication services name as opposed to a big box retailer in consumer staples, right? And very much outperforming the sector, not even close. However, the gap lower we saw in February, both of these names have struggled quite a bit. I would argue they're making lower lows and lower highs. On the short-term time frame, we are bouncing off of a low and we're testing the 200-day moving average. So if I'm a swing trader, maybe I'm taking a shot at a bit of a bounce here and using the 200-day as a stop. That's how I would probably think of it on three different time frames. So the answer to your question is it depends on your time frame, right? On if I'm more of a multi-year long-term in a retirement account kind of thing, I'm probably thrilled to buy Walmart at a $20 with a $20% coupon or $20 coupon from where it was trading about 6 weeks ago. It feels great. If I'm a medium-term investor, I'm probably cautious here because I see the distribution. I don't see any signs really of accumulation yet. So I'm probably a little hesitant. On the short term, I may take a swing trade type of approach and have minimal downside with the potential to maybe get back up toward like the 50-day moving average. I don't think that would be a bad bet to take coming out of an oversold condition. So I would encourage you when you ask a question like that, really think about the time frames that the charts would imply. And based on which of those things you're doing, if you're a long-term investor, I'd be looking at a weekly chart as well. If you're a short-term investor, a swing trader, I'd be looking at like an hourly chart or a 6-month chart and really thinking more about the short-term dynamics with maybe some different indicators. But that's how I would maybe make sense of that question that you're asking. Thanks so much for that one. Let's see, maybe one more question, and then we're done. Yeah. Jan, thanks so much for watching. Are you waiting for a big crash? I think you mean a big crash. Am I waiting for a big crash? I mean, one thing I've learned, I'll tell you what, one thing I've learned is always be looking for signs of a very negative outcome. Always look for signs for a really bullish outcome. And if there's one thing that I've learned, over my time analyzing the markets is regardless of what you think is going to happen or what you think is happening or what you think is going to happen next with the S&P, always be thinking about an alternate scenario. And I've learned that like with the S&P, I generally feel this chart is going lower for a lot of the reasons we've outlined on the show. Is there a possibility that we get up to 6,100 by the end of April? That is definitely possible. And I will say that is something that could happen. So even though I'm telling you, I think the market's going down, which I do think it is, there's a scenario it goes higher. And I'm already thinking about what would that look like? What level would hit? What trend line would I draw to track that uptrend? What would help? What would the price do relative to moving averages? What would the momentum do? So that if something like that happens, I'm not completely caught off guard. I find a lot of times individual investors get caught in a narrative. They kind of put the blinders on and they focus on their position and their trade. And then they're really excited about telling everyone else that they're wrong. Arguably, a lot of market practitioners and experts and strategists, I think, fall down that rabbit hole way too much of making their goal be telling you why other people are wrong or stupid or incorrect. Definitely not my general approach. My thought is, I hope I'm right. And here's what's going to tell me I'm right. But I'm very open to the fact that I'm going to be wrong. And if I'm wrong, this is what the chart would tell me to convince me that I'm incorrect. And I would encourage you with your own trading, with your own analysis, and with your own looking at the charts to have that approach, what's called probabilistic analysis. Look at things that are unlikely but possible, and then you won't be surprised no matter what happens in the markets. Folks, that'll do it. Thanks so much. Some philosophical end to the program today, unintended, but hey, I'm happy to go anywhere the questions take us. thanks so much for joining me on the show today. Looking forward to continuing to navigate these markets. I think we're going to have plenty to talk about here in the days and the weeks and the months to come. We've got more inflation data, GDP coming out tomorrow, PCE coming out on Friday. So make sure you tune in. We'll talk about how the markets are anticipating those numbers and how the market is reacting to that economic data, to headlines from Washington and anything else. For Market Misbehavior, I'm Dave Keller. Have a great night, everyone. And remember, it's always a good time to own good charts. Take care, folks.